Imagine this scenario. A company spends years building a financial fortress. They report a phenomenal quarter. Revenue's up, users are surging, profitability is rock solid. By every single metric you can imagine, the structure is sound. Then, overnight, Wall Street comes in with a sledgehammer and obliterates a full fifth of its value. Now, this isn't some classroom hypothetical. This is exactly what just happened to Duolingo. We're going to break down this paradox, we're going to stress test the foundation of this company, and we will determine if this collapse is a rare opportunity or fatal trapdoor. Welcome to Iron Financial, where we forge stronger portfolios by cutting through market weakness. Okay, let's dive right into this beast.
Let's start with the hard, cold, undeniable number. In after-hours trading, the stock plunged 21.95%. Let's be crystal clear about this. This isn't a dip. It is not a correction. This is a crater. A move this violent, this fast, signals that the market didn't just dislike something in the earnings report, it actively feared something. This one number is the shockwave, and our entire job today is to find the epicenter of the earthquake that caused it.
Okay, so how is that even possible? I mean, this is the fundamental disconnect that confuses every single investor out there. On one hand, you have a stellar report card for the fourth quarter. They beat analyst expectations on earnings, they beat on revenue. The company did exactly what it said it would do. It delivered. And on the other hand, you have a stock that was taken out behind the woodshed. This is the core conflict we have to resolve. When undeniably good news gets treated like an absolute catastrophe, it means the market has stopped looking in the rearview mirror and is seeing a 5-car pileup on the road ahead. Wall Street isn't just reacting to a number here, it's completely rewriting the company's entire story. All right, to get to the bottom of this, we need a clear blueprint. We're going to follow this 5-step plan. First, we'll examine the market's absolutely brutal verdict and the immediate shockwave. Second, we are going to meticulously build up this fortress of good news so you can see for yourself exactly what Wall Street chose to completely ignore. Third, we'll locate the precise crack in that foundation, the one piece of information that triggered this massive, massive sell-off. Fourth, we'll analyze their radical new strategy, what looks frankly like a high-stakes gamble on a much bigger blueprint. And finally, we'll run our own stress test to give you our verdict. Is this a structural failure, or is this a buying opportunity in disguise? Okay, Section 1, the market's brutal verdict. Let's set the scene properly, because the timing here is everything. Duolingo stock actually closed the regular trading day up over 5%. The market was optimistic, the whisper numbers were high, everybody was anticipating another powerful report. So the numbers hit the wire, the initial headlines looked pretty good, and then the earnings call began. Management started talking about the future, about 2026, and that is when the floor completely fell out from under the stock. The optimism didn't just fade, it evaporated in an instant, replaced by a tidal wave of selling. And this right here, this is the headline that tells the entire story. The keywords that sent a jolt of pure fear through the market are staring you right in the face: weak guidance and slow in user growth. For a company valued on its growth, those are poison pills. In a tumble of this magnitude, it's not just retail investors getting spooked and hitting the sell button. No way. This suggests that large institutional funds, the big money, are dumping their positions, that automated trading algorithms are firing off massive sell orders, and that a deep-seated fear about the company's entire future growth trajectory has taken root. This was not a minor course correction from Wall Street. This was a 5-alarm fire drill in a crowded theater. Now, let's pivot to our second section. Because before we analyze that crack in the foundation, we have to respect the structure itself. We need to examine the fortress of good news that Duolingo just presented to the world. Because without understanding just how strong this company appeared to be moments before the collapse, you just can't truly appreciate the severity and the shock of the market's reaction. They were, by all accounts, operating from a position of immense financial and operational strength. All right, let's drill down on the numbers, directly from their shareholder letter. Just look at the strength of this foundation. For the fourth quarter of 2025 alone, 52.7 million people use this app every single day. That is a staggering level of engagement. 12.2 million of them were paying subscribers. Revenue for the quarter was nearly $283 million. And for the full year, they crossed two major milestones: over $1 billion in revenue and over $1.15 billion in total bookings.
And just to be clear for everyone, bookings represents the total value of all subscriptions purchased during the period. It's a crucial forward-looking indicator of future revenue. These are not the numbers of a company in trouble. These are the metrics of a market leader firing on all cylinders. This is a beast.
Now, what's really interesting about this slide is the velocity. It's not just the absolute numbers, it's the rate of acceleration. Daily active users, the DAOs, were up a massive 30% year over year. Q4 revenue exploded by 35%. Full-year bookings, that key forward-looking metric we just mentioned, up 33%. And paid subscribers, the absolute lifeblood of their business model, up a rock-solid 28%. You have to understand, in a market where growth is slowing for so many tech companies, Duolingo was putting up numbers that made them look like an unstoppable force. This is a picture of a business with a powerful, well-oiled operational engine. And this quote just brilliantly illustrates the company's own confidence. Listen to the CEO, Luis von Ahn. He's not just boasting about top-line growth. He's highlighting serious profitability. Over $300 million in adjusted EBITDA. This wasn't growth for growth's sake. It was profitable, scalable growth. So the crucial point here is, you have a fortress, a massive and highly engaged user base, explosive growth rates, and strong underlying profitability. By every traditional metric, this company was at the absolute top of its game. And then, they decided to talk about the future.
And that brings us to Section 3, the crack in the foundation. Because every fortress, no matter how strong it looks from the outside, can have a hidden structural weakness. And you have to believe that the market is a ruthless inspector, and it just found a massive one. The problem wasn't what Duolingo did in the past quarter. It's what they said they were going to do, or more accurately, not do, in 2026. The past was perfect, but the future suddenly looked incredibly fragile. And here it is. This is the epicenter of the earthquake. Look at the massive disconnect between reality and expectation. Wall Street analysts, the folks who build the financial models that big funds rely on, were expecting full-year revenue of $1.26 billion for 2026. Duolingo came out and guided to a range of just $1.20 to $1.22 billion. That's a $40 million miss right at the midpoint. It's the same story for the first quarter. But the real kill shot, the number that truly terrified investors and sent this stock into an absolute nosedive, was that bookings growth forecast, just 10 to 12%. And this bar chart puts that number into brutal, unavoidable perspective. The company just finished a year delivering 33% bookings growth. They are now telling the market to expect an average of just 11% for 2026. That's not a slowdown, that's hitting a brick wall at full speed. For what we call a high multiple growth stock, and that's a company whose stock price is based almost entirely on the expectation of rapid future growth, not its current profits, a deceleration of this magnitude is a potential death sentence. The market was pricing this company for 30+% growth, and management just came out and told them to expect a third of that. That kind of deceleration doesn't just tap the brakes, it hits like a sledgehammer and completely shatters the investment thesis for a lot of funds. And here is the smoking gun. This is the admission from the CEO himself on the earnings call that put the final nail in the coffin. He confirmed that this deceleration wasn't some future problem they were anticipating. It was an existing one. The negative trend was already in motion before this new guidance was even announced. For an investor listening to that call, this quote was terrifying. It told them that the core engine was already losing power, and the company's new plan, which we're about to get to, involves deliberately throttling it even further. This isn't some temporary pothole on the road to growth. This is a planned detour onto a much, much slower road.
So what is going on here? Is the company simply falling apart? That brings us to Section 4. Is this a collapse? Or is it a strategic demolition? The company's argument, their entire narrative right now, is that this isn't a mistake or some sign of underlying weakness. No, they claim it is a deliberate, calculated, very high-stakes gamble. They are choosing to tear down a part of their existing structure, their proven short-term monetization engine, in order to build something much, much bigger for the long term. And here's the core of that new blueprint. The company is officially shifting its primary focus away from maximizing short-term bookings and profit and toward maximizing long-term daily active user growth. As the CEO puts it, they want to stop fighting for a bigger slice of the current pie and instead focus all their energy on growing the size of the pie itself. The logic is straightforward. If they can dramatically increase the number of people using the app every single day, the monetization opportunities in the future will be exponentially larger. It's a classic Wall Street strategy, really. Inflict a whole lot of pain today for a massive gain tomorrow. And this new blueprint is built on three main pillars. First, reinvest in the core product to teach languages better, and they plan on doing this primarily by leveraging AI to make the app more effective and more engaging. Second, and this is the really controversial part, improve the free user experience. This means reducing friction for non-paying users, so maybe fewer ads, more free features, making the free version so good that more people flock to the platform. This is the pillar that directly sacrifices immediate revenue for potential future users. And third, fuel new growth engines by investing heavily in their newer subjects like math, music, and chess, which they believe can attract entirely new demographics that might not be interested in language learning.
And here is the audacious goal that underpins this entire strategy. They aren't just aiming for some incremental growth. They have publicly stated a target of reaching 100 million daily active users by the year 2028. That's essentially doubling their already massive user base from where it is today. This number is everything. It's their North Star. It is the sole justification for the short-term pain they're asking investors to endure. They're essentially telling Wall Street, forget about the anemic 11% bookings growth you're going to see next year. Look at the prize we're chasing, a global learning platform with 100 million daily engaged users.
But right as they announce this painful pivot to long-term growth, which they know is going to absolutely crush the stock, they also announce a $400 million share buyback program. So which is it? Is this the board showing supreme confidence in their long-term plan, using the market's panic to buy back their own shares at a huge discount? Or is this just a financial crutch, a way to use the company's cash to put a floor under a collapsing stock price and try to soothe panicked investors? You see, a confident warrior sharpens his sword for the next battle. A nervous one just polishes his shield to deflect the current one. The market is desperately trying to figure out which one this is.
Okay, let's move to our final section, the stress test. We've seen the fortress, we have found the crack, and we've analyzed the ambitious new blueprint. Now it's time for the verdict. We're going to put the bull case and the bear case head-to-head to determine if Duolingo's stock, after this 22% haircut, is now a massive opportunity or a very dangerous trapdoor.
All right, let's start with the bull case. The argument here is that you have to look past the 2026 speed bump and focus on the 2028 destination. Management is painting a picture of a $2.5 billion business with over $700 million in EBITDA if, and it's a big if, they hit their 100 million DAU target. They have a huge opportunity to leverage AI to create a truly best-in-class learning tool, something no competitor can possibly match. Their new growth engines, well, they aren't just a theory. The chess vertical already has 7 million daily active users in less than a year. That's incredible. And most importantly, they're making this strategic pivot from a position of incredible financial strength, with a strong balance sheet and solid profitability. Now for the bear case. And it all comes down to one thing: execution risk. The guidance miss wasn't small, it was a chasm, which seriously shakes your confidence in management's ability to forecast their own business. They are asking investors to sacrifice tangible, predictable profits today for highly uncertain user growth tomorrow. And let's not forget the CEO's own admission. User growth was already decelerating. What if this new plan is just a desperate attempt to fix a problem that's actually bigger than they're letting on? What if they spend all this money, hurt their margins, and the user growth doesn't reaccelerate as planned? The new CFO was crystal clear. Spending on R&D and marketing will outpace revenue growth in 2026. That is a very, very dangerous formula if the top-line growth doesn't materialize on the other side.
So we end where we began. Is Duolingo's new blueprint an opportunity to buy a great company at a 22% discount? Or is it a trapdoor leading to more pain? The answer really comes down to your time horizon and your faith in leadership. If you believe in the CEO's vision of a 100 million user platform, and you have the patience to wait 2 to 3 years for this strategic demolition and reconstruction to pay off, then this could be a compelling entry point. But if you see a company that just shattered its growth story, is admitting to existing deceleration, and is deliberately stepping into a period of lower growth and lower margins with absolutely no guarantee of success on the other side, then this is a structure you stay far, far away from. The fortress is being redesigned. The question for every investor now is, do you trust the architect?
Quick disclaimer, everything I share is for entertainment and informational purposes only. I'm not a financial advisor, so please do your own research or talk to a professional before making any moves with your money.